By the way, class, expect to encounter a lot of similarities between the provisions in PAS 16 and PAS 38. They are closely related. They are very similar, class. Uh, Basically, the primary distinction between uh, an item of PPE and an item of intangible asset is as regards to their physical substance, okay, which was the third important component of the definition of an intangible asset. Here, class, it tells us that there is really an issue as to the recognition of intangible assets, class, because it's very difficult to distinguish costs related to the development or creation of tangible assets and costs related to the operation of the business lang. Uh, there are costs, class, that we must spend to be able to operate our business, which could be confused as an intangible asset. But this is the rule, class, which is also provided in the standard. In case of doubt, as to whether a cost should be recognized as an intangible asset or it should be expensed, the issue should be settled in favor of recognizing it only as an expense. So by the time you'll be asked a question, class, you're asked to determine whether a certain cost is an expense or an asset, and you are uncertain, class, and you are unable to clearly apply the other rules of the standard, class, then it is safer for you to recognize it as an expense. Okay. So here, paragraph 9 tells us, class, as I mentioned earlier, that entities frequently expend resources or incur liabilities on the acquisition, development, maintenance, or enhancement of intangible resources. But in paragraph 10, it tells us that not all the items, class, enumerated in paragraph 9 will meet the definition of an intangible asset, primarily because of identifiability, class, and the ability to control the resource and the existence of the future economic benefits. Okay, basically, this is what we've talked about earlier. I've also mentioned that it would be difficult to distinguish the cost as a cost of doing business or as a cost related to the creation of an asset. Okay, and if you have that difficulty, class, then that would make that cost fail as to the requirement of separability, class. If you cannot distinguish it, class, then that means it's very difficult to separate the cost from other items. And in that case, that cost or that expenditure should not be recognized as an asset. Okay. So moving on to identifiability, class. Again, it's very important that an asset must be identifiable. Now here, I've underlined that goodwill recognized in a business combination is an asset representing the future economic benefits arising from other assets acquired in a business combination that are not individually identified and separately recognized. I always tell students, class, that at this point it is not important for you to be sorry, it's not wise for you to be overly concerned with goodwill, class. Goodwill again will be covered by uh, PFRS 3. Okay, but if there's anything you should remember about goodwill, class, let it be these two things, class. Number one, that goodwill is an intangible asset, but it is a kind of intangible asset that is not identifiable. So this is more of an exemption, class. We allow the recognition of goodwill, class, even though it is not identifiable. Okay, simply because of the transaction from which it arises, class. And this leads me to the second thing you should be able to remember about goodwill. Again, the first one is that goodwill is an intangible asset. But what makes it unique is that it is an intangible asset that is not identifiable, class. Okay. Uh, but if for some reason you expect to get future economic benefits from it, class, but you cannot pinpoint as to what gives rise to this economic resource, class. Second thing to remember, class, is that goodwill will only arise from a business combination, class. Okay. And because of that uh, limited instance from which goodwill can arise, class, we are able to justify recognizing goodwill even though it is not identifiable. Okay. So again, please do not overly concern yourselves with goodwill, class. At least remember those two things, that goodwill is an unidentifiable intangible asset, and second, goodwill shall only be recognized if it arises from a business combination. So those should be your two takeaways about goodwill, class. That goodwill is an intangible asset, even though it is not identifiable, it can already be recognized, provided, number two, that it is a goodwill that arose from a business combination. The kind of goodwill, class, that can be recognized in the financial statements would be the goodwill that arises from a business combination. Okay, and even though I really do not want you to dwell so much on goodwill, class, let me just uh, give you a brief idea as to how this works, class. Again, very important, goodwill will only arise from a business combination, class. Okay, so you have two companies, class. Company A will acquire company B. Okay, it can be a partial acquisition, class, or full acquisition, everything 100% acquisition. Okay, but let's not focus so much there. To simplify our example, let's just say that the entirety of company B will be acquired by company A. Okay, assuming, class, company B only has 5 assets, no liabilities. Okay, so company A, by acquiring company B, will become the owner of those 5 assets, class. Okay, and if company A is buying the company B, class, the assets that were previously owned by company B will now become the asset of company A, will form part of the asset of the acquirer. Okay. And as to the question on how these assets will be recognized, class, the rule is that the assets of the acquiree, in our example, company B, will be recognized by the acquirer at fair value. Okay. So supposing, class, the 5 assets previously owned by company B had an individual fair value of 200,000. Okay. So company B has 5 assets, and uh, each of these asset has a fair value of 200,000. Okay. So that means you could have bought the entirety of the assets of company B for a total amount of 1 million. Now, the issue here, class, is company A, class, paid 1,500,000 to acquire the entirety of company B. Okay. But what does company B have? Company B only has 5 assets with an aggregate fair value of 1 million. So the question now is, why was company A paying 1,500,000 when the individual assets that comprise company B was only worth 1 million? Okay. And the answer, class, is that the extra 500,000 that company A was willing to pay, class, represents goodwill. Okay. Basically, class, the premise here is that company A is not crazy, class. Okay. Company A is not crazy. Why would he pay 1,500,000 when the aggregate values of the individual assets that comprise the asset is only worth 1 million? Okay, because we are working under the assumption that company A, our acquirer, is not crazy, class. Then that means company A sees something in company B, class, that is worth 500,000 aside from its existing assets. Okay, only a crazy person would have paid extra 500,000, class. But we are working under the assumption that our acquirer is not crazy, man. So, the only rational explanation here, class, is that company A sees something in company B that is worth 500,000. And that something is entirely separate from the assets that are previously owned by the acquiree, that were previously owned by company B. And the something class that company A sees in company B is what we will refer to as a goodwill class. Supposedly, if you paid 1,500,000 for something that is worth 1 million class, then you would have said that you had a loss in that transaction. But again, we are working under the assumption that our acquirer is a reasonable entity. So the only reason that the entity is willing to pay more than the aggregate value of the assets that comprise the acquiree is that there is something in the acquiree class that the acquirer sees value in. And whatever that something is class is what we refer to as our goodwill. Okay? And that's the reason class that goodwill really is not identifiable, because it is something that only comes out as a result of the appreciation of the acquirer class. The perceived value of the acquirer over the business of the acquiree. In an opposite scenario class, company B is still worth 1 million. The individual assets of company B collectively still worth 1 million. If it so happened, class, that company A, the acquirer, is only willing to pay 800,000 class. Okay. Of course, the assets that will be carried over carried over or given to company A class would be worth 1 million. But company A only paid 800,000. Okay. And in that case, in that case, company A will be recognizing a gain on acquisition. Okay, so a business combination class will either result in a goodwill or a gain on acquisition. It makes sense why there is a gain class, because the value of the assets that we will recognize, since it will be recognized at fair value, is greater than the amount that we paid for it. Okay, unlike in your past 16 or even in past 38, assets acquired are recognized at cost. So if you paid 800,000, then it should be recognized at 800,000. Okay, but in a business combination, the assets acquired are to be valued at fair value. So there will be a difference between the value acquired and the payment given. And the difference there would be treated as either a goodwill or a gain. If you pay more, instead of recognizing a loss for having to pay more than the fair value of the company you have acquired, it would be recognized as a goodwill and not as a loss. Because again, we are working under the assumption that the acquirer is reasonable and he would not have paid far more than the value of the assets comprising the asset if the acquirer did not see anything special in the entity. If you pay less, then that means you have a gain from the acquisition. Okay, so again, that may have just made you more confused, class. But at this point, at least your takeaway would be that goodwill will only arise from a business combination, and goodwill is an intangible asset that is not identifiable. Okay, there's a need to expound a bit on goodwill, class, as I have already did, because our common understanding, the layman's understanding of goodwill, class, would simply be the relationship built by a business with its customers or the public class. You would say that there is goodwill between the business and the public if the business does good, if the business treats well its customers, so on and so forth. If it spends a lot of resources for developing a good reputation, then we would say that there is goodwill, that this business enjoys goodwill. But that is not the kind of goodwill that we recognize in accounting class. The only goodwill that we recognize in accounting are those that arise from a business combination. Okay, goodwill represents the something that an acquirer sees in the acquiree beyond the assets owned by the acquiree that are separable and identifiable class. Okay, and if you've noticed earlier, we've mentioned that internally generated brand or any other asset that is a result of your good relations with customers class will not be recognized separately as an intangible asset. Okay, goodwill the layman's understanding of goodwill will fall in that category. Okay, the establishment of a good reputation, that will not be recognized as a goodwill. The goodwill that will be recognized, class, would be those that arise from a business combination. Okay.